make sure we're clear on a few things, a couple of quick ideas I want to make sure I put down, and then we're going to let Michaela run with this. The biggest thing is most of us are in a period where we're selling animals for more than we have ever thought possible. I want to put the bug in your ear of financial literacy, and one of the reasons we focus on all this stuff we do, financial literacy is one of your keys to making good decisions with extra money. Now, not everybody has extra money right now. That's not a universal case, but markets are very high. And so sometimes that means that, we have significant proceeds. As the dollar numbers go up, in my mind, the importance of us being skilled as stewards of that becomes more and more critical. Um, Michaela has been doing a lot of work. Some of you may have heard we've done some podcasts recently on the importance of financial literacy. Michaela's been doing a lot of work on that lately on our team, and I have really enjoyed seeing the stuff she has come up with. We have a few good opportunities coming up for continuing ed. If you would look at the ranching.fyi page, make sure you're catching the Ransonomics podcast, and please continue coming to these webinars. We'd like to see you there. If you haven't heard, there is a sell by marketing call on FYI on Monday mornings. We have been doing a financial Q&A call on Thursday mornings. The time for that is going to change. You should receive an announcement about that shortly. I believe it's going to be Wednesday late afternoon, about this same time slot, weekly on Wednesday at 2 p.m. Mountain. We will go ahead and get started. Michaela, is there anything else we need to talk about before we get going?
I don't think so.
Okay, and I think I'll double check this with you. If you have people with questions during your presentation, you just as soon take them while you're presenting, then wait till the end. Is that right?
Yes.
Okay. Then, as my 3-year-old says, rock on.
Rock on. Okay. Are you able to see my presentation here?
Yes.
Perfect. Can you see my mouse?
Yes.
I think I might change it to the laser pointer. Is that better?
Love it. Yeah, very good.
Very good. Okay, so last month we spent a lot of time talking about uh, profitability in the P&L, but we started with a metaphor. We said a good business is a vehicle for building wealth. And within that business, the vehicle's engine is much like the profitability of a business. It's the thing that gives the business power and gives you power as the owner to move down the road towards your goals. And we use the profit and loss statement or the income statement to measure and analyze the business profitability. So last month we broke down the different parts of the P&L, and then we also talked about how we're going to use the P&L to fine-tune your engine and um, hit the targets that we're going to be talking about today. But before we get into that too much, I do want to make sure that we understand the different parts of the P&L. So the very top line is going to be your gross product. And this can be revenue, this can be inventory value, your inventory value going up. Basically, it's the total value that you're producing as a business. Next, we're going to add or rather subtract the direct costs out. You can see them here. When we subtract the direct cost from the gross product, that gives us gross profit. And when expressed as a percentage, we call it gross margin. If y'all have seen the financial statements that RanchRight sends out, you most likely have multiple enterprises. This is where you would see the income and the direct costs associated with each enterprise broken out across the top. And then the next part, where we add overheads, we usually have all of our overheads lumped into one group and in the general category. And the reason why is because overheads often aren't separated into different enterprises. They're the expenses that just make the whole operation function and possible. So the way this reads then is we have $100,000 of income, we subtract $30,000 of direct cost, and that leaves us, excuse me, that leaves us with $70,000 of gross profit that can go to pay overheads. And then the very last piece here that's left over is your net operating income. There's one more part here that we're not going to spend much time on today. It's just the other income and other expenses. And the very bottom line here is just your plain bottom line net income. The reason we're not going to talk about it much today is the other income and other expenses tend to be more variable, and they also don't, um, they're not involved with the actual operations of the business. So as we talk about planning for recurring profit, we want to make sure that we're focusing on the profit that the business is actually generating with operations. So we're just going to cross those two out. And I do want to mention here, you can see that interest expense is a big part of the other expenses, but we're going to capture that interest expense when we talk about debt payments. So we can feel good about crossing these out for now and focusing on net operating income. And this is the question that we really dove into last month. Is this enough profit to support your goals? There's two parts to that, right? You have to define your goals, and then we can talk about if this is not enough profit to support your goals, then we can talk about actually fine-tuning your business, your engine to make that more profitable. So today, in the last webinar, we really focused on the parts and the different methods behind fine-tuning the engine. Today, we want to start with the map. That is, where are we going? What are your goals? And then we're going to actually create a plan for achieving profitability that supports your goals. So we'll first set some clear, meaningful goals. Then we'll use those goals to calculate targets. And then once we have those targets, we can actually begin to use some of those, the things that we learned last month to actually fine tune the engine. And then at the very end, we'll double back to our goals and make sure that the profit we're creating successfully supports them. So we'll start with, what are your goals? What do you want to experience? What kind of impact do you want to have on the world? And um, I really like, I want to spend a little time with these two ideas. Last month we said your goals are like the destination. And I would still say that's true, but I think there's a really important distinction here. The destination goals are your long-term vision. That's where you want to end up at the end of your life. But so many of our really big long-term goals, they don't just happen all at once. They happen in little pieces, or we have to account for those little pieces along the way. So for example, if you want to buy a new house or buy more land, most of the time those are big purchases that 1 year's profitability won't be able to support. So as a result, we break them out into pieces, whether that's financing them and making payments over time, or saving up profit and then buying them outright later. Either way, you're creating a recurring goal, a much smaller goal that builds over time to help you reach the big destination goal. And while I was putting this together, I came to this word payload, which has a couple different definitions, and I think two of them are really helpful here. The first is it's the weight that a vehicle can carry, like its actual carrying capacity, how much it can like legitimately haul down the road, which is important because as our little cartoon here represents, the wagon can get pretty heavy and sometimes require some pretty serious profitability. The other part of the definition that I think is really important is the payload describes the mission critical cargo. So it's not just all the extra things on board, it's the stuff that's really important, that's driving the mission. The things that without these things, the mission isn't viable. So these are the goals, your priorities that make all your work worthwhile. And once we define these goals, both your destination goals and break them down into smaller pieces like we'll do today, then you know how much horsepower you actually need every year. And that's where we can kind of dig into the P&L, the different parts of the P&L, and try to work backwards from our targets to understanding what needs to change in our business. So I am going to talk a lot, you can probably tell, I'm going to talk a lot about personal goals today. And I just want to take a minute to emphasize there are some differences here, particularly because we are so careful for accounting purposes to separate personal and business. There's a couple reasons we do that. We want to keep everything clear for lenders, for the owners of the business, and for the IRS. We want to be able to measure business performance specifically. And we also want accurate information that is detailed and separate so that we can do our analysis and make good decisions both on a personal level and a business level. However, when it comes to goal setting and planning, we're going to use that information. We're going to combine it, and or let me be a bit more specific. For accounting, we're looking at the past, and we're going to be careful to separate the past, personal and business. When we're goal setting, we change our view so that we're looking toward the future. And when we look toward the future, it's important to combine both personal and business to make sure that we're getting a holistic view. And I think this crowd is very aware, I think, of this idea here that the business is a tool to support your goals. Um, not the other way around. I know it sometimes feels that way, but we want your business to be supportive of your personal goals and values. We want to ensure that your time and money are aligned with your priorities. And when we take a holistic view, it's going to keep the decision making in context and create motivation. So, are there any questions about that idea of keeping the past transactions separate, but looking at all of it together for the future? Okay, very good. And we'll continue with defining goals. We've got I've got a couple different breakouts here. The first is legacy goals. This is going to be your long-term vision. And I would say that this is where personal and business goals sort of collide. This is the long-term vision, your whys, the values that you have, the motivations for your work. And then once we start to break these down, or once we start to establish the organizational and profit goals that support these legacy goals, then it can get more specific towards your business. So, for example, organizational goals would be like the non monetary goals. These are the things that money cannot buy, usually based around relationships and systems. So while you can buy technology to improve systems, you can hire people to build out a team. Um, but really, the spending of that money would be included as a profit goal. The actual making those things effective would be organizational goals. And we're going to look at some examples here in a minute. The profit goals are going to be your short term financial goals. These are the things that money can buy. The things that, if someone asked you, what would you do with more money? The answers that you would give would fall into this profit goals category. And for the rest of today, will be focused on this profit goals piece of it. And the just the way this kind of worked out, we start really high level, and as we go, we're going to get more and more granular. Um, I hope that makes sense. But if you ever want to stop along the way, please just stop me. Okay, I'm not as funny as Steve Harvey, but I thought this would be a good opportunity to play a little ranch right family feud. So I'm just going to call them out. These are a lot of goals that we hear from our clients. We've got legacy, organizational profit, and um, I'll just go through a few of them here. We've got empower the next generation, whether that's financial or even just raising good people, giving the next generation a good foundation. We often hear about land and animal stewardship being a very motivating factor. It's a lot of times why we do what we do. We want to build resilient communities and produce nutrient dense food. And this is by no means an exhaustive list. This is just the things that came to mind as I was preparing these slides, the things that I hear about a lot. Organizational goals are often things like improving teamwork and relationships, whether that's with family or employees. Self-reliant systems, that's, creating systems that can continue to run without you to create that freedom. Um, Creating better culture, and even something as simple as just changing an entity isn't always simple, but it can be something kind of black and white like that also. All right. When we get to profit goals, there's one that we hear more than any other. I meant to not show that. I was going to make John guess what it was, but I feel like you would have known. More often than not, we hear about buying land, and I think it's just something that is inherent in our industry. It's a family thing. It's the pride of ownership. We hear a lot about buying land. We also hear about working on the farm or ranch full time, building a house, buying into a family operation, and improving working capital. So again, there's so many more goals out there. These were just the ones that came to mind that I think are good examples. Um, so before we go any further, if you could let's just take a mental break for a second and think about your legacy goals, organizational goals, and profit goals. What what's driving you? Why are you um, in this business? What are you pursuing? So just pick one of those for now, and then uh, you can pick an organizational goal and a profit goal that supports that. And I'm sure there would likely be many, but you can just pick one. This is just to kind of kickstart the process. And if you want to write down multiple profit goals, we're going to be talking through the framework of how to think about them and where these variables plug in to find your targets. So if you do have multiple profit goals, um, feel free to write those down.
And that's where we play the music, right?
This is where we need some music. Yeah. Would you have guessed by land, John?
Yes. Would pay down debt go in that category also?
Yes.
Okay, those would be my top two guesses in that category. Frequency of, how often we hear them.
Right.
But I know that you have a tremendous bias towards byland also, so I guarantee you hear that
Guilty.
more.
Guilty. Yep.
Yeah. The rest of you, if you don't live in Tennessee, Michaela doesn't want to own all of the land, just anything that touches hers.
I'm for some context here. I'm married to a row crop farmer, and if I asked him that question, what would you like to do with more money? That would be the only thing he would say. But
Yes.
Yeah, I've spent a lot of time, holding the reins on that deal. Okay. Does anybody want to share any goals that didn't make my list? Are there anything goals, organization, or profit that we missed and need to add to the list?
I had operate on our own money.
Very good. We're going to talk more about that. Any other volunteers? Maybe we made a pretty good list.
Quiet crowd today. We must all be feeling shy.
Yeah, that's okay. Okay, so let's dig a little deeper into these profit goals. They do all require more money, but there are some key differences. So we'll start with land. Land is usually being financed, and that financing creates a long-term recurring payment. Let's compare this to working full-time for the business. Rather than creating a recurring debt payment that has to be paid with the after-tax dollars coming out of net operating income, this profit goal is actually going to increase your overheads. Same with building a house. Um, it's not, we've heard before, building a house could be a additional profit goal or target profit goal. Same thing with a vacation. But anything that's going to be paid for, like, is a personal expense that should be paid for with personal income, we want to get in the frame of mind of, calling that an overhead, calling that salary, so that you can afford to pay for that with personal income. And I know we're splitting hairs a little bit here, but I think it will be more apparent as we get into the P&L. And it's just talking about that financial literacy component to this. We just want to make sure that um, we're understanding how the P&L works, and also understanding how we support our business and how our business supports us.
And what do you do if you buy something? Let's say you buy a farm and it's got a house on it that you rent out, and there's no other source of income. So is that still like, does that go into the other income category? So you still account for it, but it's not the operation, even though the operation is paying for the farm? Or
Ooh, that's a good question. Um, I think we'll get into this a bit more in just a minute.
okay,
But I
fine.
think, yeah, I think what you're describing there it's just good context that there's a lot more going on than just the business, right? Like there's other investments, other entities, other things that could be going on. And we'll come right back to that, okay? Very good question.
But can I
Okay.
ask you a quick question, Michaela? When you were talking about this, you were thinking about building a house for the family, right?
Yes, when I put
Okay.
this here, I was thinking of whether it's building or buying just a new house, like increasing your family standard of living, that sort of thing.
Yeah. Yeah.
Okay, so then we've got buying into the family operation. This is unique because it does create a significant financial obligation that could be a one-time thing, or it could be spread out over time. Either way, it's likely going to create significant changes to the operation as well. And then this is for Betsy. We've got improve your working capital. This is very similar to what you described uh, with operating on your own money. What this is truly an additional profit goal where it's not going to be, there's no debt payment involved. It's not going to come out of overheads. This is simply wanting to produce more profit every year so that you can retain that cash in the business increase your working capital, pay for your operating expenses. And this is actually the only one on this whole list that decreases risk. So that's interesting. Additional profit goals, you know, oftentimes increase risk, but in this case, you're taking risk off the table. So that's very cool. Okay, so this is where we're going to put our profit goals into 3 buckets. And the list you saw there will fit naturally into these 3 buckets. We're either going to be increasing our salary or distributions from the business. That can be things like working full time, building a house, going on vacation, even hiring additional help. We're going to have a second bucket that is recurring debt payments, buying land, buying equipment, purchasing livestock with a loan, purchasing ownership in the family operation. And then this is the third and last bucket that's just true additional profit. This is going to be profit that is reinvested into the business. So, you know, it's not leaving the business through a debt payment, it's not leaving through overheads, it's actually going to reinvest in the business to increase working capital or purchase assets with cash. And think of these as the 3 variables. You know, we've spent quite a bit of time to get to these 3 variables, but these are the 3 variables that we're going to be using to calculate your targets. So within salary, we're going to spend a little time here because it's important. You've got family living expenses, all the necessities, also any investments. And I think this is something that people often forget. When you're thinking about family living, you've got your base expenses, but you also need to think about things like retirement accounts, if you want to save like a education fund for your child, if you want more vacations or experiences, and I'm calling those investments. Some people may disagree with me, but I'm going to say they're investments in your mental health, in your family. Then you've got charitable giving and investments in your community. And then you've got upgrades on top of that. So maybe this is all your basic needs are met, but you would like to have a nicer house or a nicer car. I don't think any of those things are bad. I think it's important to be really realistic about what you want. Because we're going to set some targets today, and then we're going to try to hit those targets. So if a new house is on the list, that's great. Let's just be realistic about it. Okay, so after we cover the necessities, then we're going to create a plan to achieve the rest. And I heard it said a long time ago, and it's just stuck with me all this time. You can afford anything, but not everything. And it just gets to the heart of choosing meaningful priorities. And then we have to understand that it's going to take some time to get there. And we got to keep our lifestyle flexible while we work toward our lifestyle goals. So all of that last slide fits into this family living box. We have a lot of other things to think about here too. So today we're going to primarily focus on this sort of a gold path here. We're going from the salary from your business, how that influences your personal income. And then we do need that to pay your taxes, your family living, which we just described, and then any other meaningful goals that you have. And that could look like reinvesting in the business. It could look like reinvesting in other businesses. Treg, this is where I think if I understood your question, this is kind of where my mind went, that if you have other businesses outside of just the farm or ranch, it's totally reasonable to make that a profit goal if you want to invest in that. And this is why we bring the personal goals into view, because we kind of have this matrix of money flowing through our life, money coming from the business, non-farm, non-ranch money, other income, and we have to allocate it according to what we want to accomplish with our life. You know, taxes are non-negotiable, but everything else is up to us. And this personal income contribution, this is going to be a variable in the calculation. It's simply any non-business income you have plus your business salary minus your family living. And I didn't put minus taxes, but we're gonna get more to that. So personal income, just to be clear, personal income should never subsidize your business operations. I don't ever want you to think that I'm telling you to put personal income into your business unless you're intentionally reinvesting in your business with the purpose of growing your money. But I'm not saying that personal income should be a crutch. So what we do want personal income to do, and I'm talking about this total personal income, we want it to be spent very meaningfully. Okay, so now we're going to look at the second bucket, that is recurring debt payments. And I think this is the most important part. When you have recurring payments, you're going to have recurring risk. So what that means is when you sign up for a payment, every year until that payment's gone, and I know this is basic, right? Y'all know this. I find it's easy to realize, like, in that year you have to make the payment, but when you recognize that if you're buying land, it could be 20, 30 years into the future, you're accepting that recurring risk for 20 to 30 years in the future. So we often do the calculation based off our income today, but it's really important. And this is why we have this term debt coverage ratio. This is to manage this reoccurring risk. So because we have to pay taxes on the income before we make any debt payments, and because we want to include some margin there to protect us against the many risks we face, we're going to say that we want to make all of our debt payment plus another 50%. So that's what this 1.5 means when we say we have a recommended term debt coverage ratio of 1.5. That means that we would like to see your recurring income be able to make any recurring payments 1.5 times. And that's sort of the minimum. That should cover any taxes. We hope it covers enough margin. But this is where if you are risk averse or if you're in a particularly risky business, it would be a good idea to increase this maybe to 2, or whatever suits your risk tolerance. Basically, if you had a 2 here, then you would be able to make your debt payments 2 times with your recurring income.
Is recurring income, is that realized profit? What?
Great question. Yes, so last month we talked about the difference between realized versus unrealized profit. And this really, we could really go into a rabbit hole here. And it may be more helpful to dig into this like when we talk about cash flow, but it's essentially the profit is there, the value has been made, but when you have unrealized profit, it's sitting in inventory. So we can't make our debt payments with value that has been created but is still held in inventory. So this is where it's important to have enough. I can see what you're saying. The recurring income, we can think of it as all income, but we have to be careful and make sure that we have at least enough realized income to make the payment, pay the taxes, and have some margin. John, would you consider this 1.5 only realized income?
No, I would say it's all, but it does depend on the specifics of the business. One of the things Michaela's going to mention before she finishes is we have to make sure we understand cash. And that's a future topic. But I think if we just start with our net income and 1.5, in most cases, we're okay.
And this is a good place to recognize the power of having some extra working capital, because once you've created the value, that's a great thing. It's there. But if you have some working capital that you could use to kind of bridge any gaps before you're ready to actually convert that to cash, then that would help manage this recurring risk.
One other thing I would mention on this slide, Michaela, is that there are banks that will let you go significantly below 1.5.
Mm-hmm.
Just because the bank allows it does not mean it's a good idea. We
Right.
did a podcast interview with David Cole a while back. He is one of the people that started this 1.5 limit on debt coverage, and he's a big advocate for it. And the reason is there is no risk-free plan, but this keeps you in the area where the probability of being able to make it is good, and that's what we're trying to do. So if Farm Services will let you get down to 1.2, again, that's their criteria for lending. We do not recommend following that because we think that puts you at too much risk. So just because you can doesn't mean you should.
Right. Especially as the payment amount goes up and your
Yes.
taxes would go up also, it's even more important to stay really firm with this 1.5 or go higher.
Yeah.
Very good. Okay, our last bucket kind of goes right along with this conversation. This is, do you want any additional cash outside of increasing your personal income or making recurring debt payments? Do you want anything on top of that? So this would be to purchase to purchase assets without financing. So if you wanted to grow your herd with your profit every year, it could also be to just increase your working capital so that you can finance your operations and decrease risk. So I think, what we just talked about, the term debt coverage ratio, having a solid term debt coverage ratio, and then including a little additional profit is a great way to manage risk. Okay, so those profit goals that you wrote down earlier, where would you put them? Would it be an increase in salary? And there's two different parts here. On the one side, you might need some more money, whether it's to pay for family living or support lifestyle goals, or you may have extra personal income that you would like to contribute towards your goals. So this kind of goes either way. We've got recurring debt payments. Do you want to be able to afford additional debt in the future? And if so, how much margin do you want to have to manage that risk? And then lastly, do you want to have any additional profit in the form of cash to reinvest into your business? Okay, so we finally get to the point where we get to work an example. We're going to find two things here. We've got a salary adjustment. Does this family need more personal income? And then we've also got the target net operating income equation. So these are the two things that we need to be able to work in reverse order through the P&L. Just for the sake of time, I'm just going to go ahead and walk through this. We've got $60,000 in non-farm income, another $10,000 in business salary. So this is coming from the farm. And then we've got $80,000 in family living. So in this scenario, we need to increase our overheads by $10,000. We also have an additional profit goal of $10,000. We want to increase our working capital, like Betsy said. We'd like to build that up so we can finance our own operations. And we've got $12,000 of existing debt payments. These are all just examples, but let's just say that's for some equipment. And then let's say we've identified a little tract nearby that would create an additional $18,000 of recurring payments. So the second calculation here would be taking our recurring debt payments, $30,000 altogether, multiplying that by the debt coverage ratio. That would get us to 45,000. Then we're going to add 10,000 on top of that. And this identifies our target net operating income as 55,000. Now, we're going to go back to this profit and loss that we looked at earlier. And you may recognize these numbers are the same numbers we looked at last month, just with 4 extra zeros. So we came up with $30,000 at the bottom here, net operating income, but we just said our target profit is 55,000. So this is where we need to begin fine-tuning the engine. And these are not in sequential order. This is not the order that you should do these. I'm just going to go through them quickly, and then we'll talk about how to use each of them. So at the top here, we can increase gross product, increase the total value produced. We can improve our gross margin. That means less money would be spent on direct costs and more would flow down, pay overheads, and we would have more money left over at the bottom. Or we could decrease overheads. Now, we talked about these in detail last month. For the rest of today, I'd like to talk about how we can use these, particularly in reverse order, to take our target profit, focus on that, and work backwards, see where we need to be. So if we just have these list of things, it's difficult to know where to start, but I would advocate for starting with the end in mind. So we've identified how much we need to reach our goals, and I should pause here. Does anyone have any questions about how we got this number? Because this is a really important component.
Yes.
Okay.
It's 1.5 times of something, but I'm not sure what.
Yes. We've got, and so remember, we're separating any personal income needs with this salary adjustment. And then what we have left is the target net operating income, which the variables here are your recurring debt payments, your term debt coverage ratio, and then any additional profit that you'd like to have on top of that. So just what you said, it's the recurring debt payments multiplied by 1.5. And then in this situation, we want additional profit of $10,000 to add to our working capital. So we added that on the end. Any other questions about either of these variables? Okay, so we're just going to plug them in now. We've got the target profit of 55,000. And traditionally, you'll hear people talk about decreasing overheads when you're trying to improve profitability. I've slightly changed that for our discussion today to focus on target overheads, with the idea that we're not necessarily just trying to decrease, but we want to be really intentional with our overheads. So if you need more salary, or if you've earned more salary because of the work you're putting into the business, it's okay to increase overheads. Make those salary adjustments, which we've done here. We've added $10,000 to our previous overheads, went from 40,000 to 50,000. And then we're just going to make sure overheads are reasonable. This gives us a new gross profit target of 105,000. Now, the next thing we're going to do is improve gross margin. Remember, gross margin is just a percentage of gross profit. So this is the most complicated math we're going to do all day. We're going to solve for gross product using this percentage. It's going to be the gross profit divided by the gross margin. So this is an important equation. If you're trying to figure this out for yourself, there's going to be 2 equations here that you'll probably want to write down. So we have our gross profit identified using our targets. Then we're going to divide that by our gross margin. And in this case, this is like a historical gross margin. This is something that's been identified in the past. And it tells us that based on our historical gross margin, we're going to need $150,000 in the future. That's in gross product. The key here is the higher your gross margin, the less gross product you actually have to reach your target because you're being more efficient. Then we can solve for direct cost. And this one's simple. We're just taking our gross product, and we're subtracting out our gross profit. So that gives us $45,000 in direct cost. The last thing we could do, the last tool that we have here, is to increase our gross product. So by following this calculation all the way through, we know what gross product we have to have. Remember, we started with 100,000. Now we're at 150,000. So it's saying we would need to increase our gross product by $50,000 if we want to hit these targets. Now, looking at the reverse P&L like this, we're reliant on the historical gross margin, and we're limited because this is a total profit and loss statement. We aren't able to see the enterprises within each. So, for example, the target net operating income, the target overheads, these are operational level line items. But the challenge here is that we have a lot of enterprises within our business, usually, that have different gross margins and different gross products. So this formula that we just went through gives you a high level understanding of what needs to change for you to be able to hit these targets. But there's also a process for digging into the details, and it's we'll just walk through it together. Any questions so far about this piece? And if you have questions as we go through this math, just let me know. So again, we're back to our two variables, our salary adjustment and our target net operating income. These, you can just see the variables going into them right here. Here's what I'm suggesting is the 2024 actuals for this example, and they are in reverse order. Here we've got net operating income on top. We can start here at the bottom. This was the gross product produced, the direct cost, so we're subtracting that out. We're subtracting out the overheads, and this gives us our $30,000 of net operating income. So these two highlighted boxes are the things we want to change. We want to increase our overheads by $10,000, and we want to hit the $55,000 here for net operating income. There's our $10,000 change, and there's where we want to see the $55,000 in the future. So let's start with overheads. We're going to go ahead and make this salary adjustment, the additional $10,000. And then beyond that, I recommend just asking, are overheads reasonable? And, right off the bat here, we see that the overhead ratio has changed from 40 to 50, which feels like we're going in the wrong direction. But we've got other levers to pull and other things to address. So we'll come back to that in a minute. I think overall, $50,000 in overheads is a pretty lean operation here. I don't see anything major that we need to adjust. So we're just going to assume for now that for this operation, overheads are reasonable, and we can go on to the next step. Next, we have gross margin. And this is where we're drilling in on efficiency. So these columns here, the tan columns, this is going to be the direct cost per unit for cow-calf, for stockers, and hay. We've got 3 enterprises here. Because this is a reverse P&L, we've got direct cost on top. This dark blue represents the total. And then we've got gross product on the bottom. So these are the direct cost, total direct costs for each unit produced. Here's your income for each unit produced. So the way this would read is the cow-calf enterprise produces $950 of value per unit, and it cost $176 per unit, which leaves you with a gross profit of $773, which is 81%. So said another way, for every dollar that your cow-calf herd produces, you're keeping 81 cents to pay your overheads and create your net operating profit. So now we're just going to add columns to this. You're going to see them show up right here, that we're just kind of stretching the enterprise out, and the new column, this is what our plan is going to show up right here to the right. These are the changes we're making. And these are just some examples. I want to emphasize here that I'm sure the numbers aren't totally, I'm sure you could find things you would like to change about the numbers, but we want to focus more on the relationships than the numbers themselves. So I think it's good enough to give us a good example here. For reducing direct cost per unit, this operation may improve forage stockpile and grazing management to feed less hay and reduce hay cost. Another good option is to adjust the calving window to better match the feed resources, reducing feeding costs. And then improving stockmanship and receiving protocols can absolutely reduce vet calls and medicine. So you can see we've made these changes. They're highlighted here. Does anybody have I know this is a lot of numbers to throw at you at once. So does anyone have any questions about these numbers for this chart?
Michaela, will we be able to look back at this somewhere, like either your presentation or maybe on YouTube?
Yes, yes.
Okay, super. Thank you.
Yeah, of course.
I'm glad you brought that up, Danny. I meant to mention that at the beginning. This is recorded and will be on the YouTube.
Super. Thanks, John.
Yep.
So the thing we really want to see here is that the changes we're making are improving our gross margin. So you can see we went from 81.5 to 84.2. Here we went from 77 to 81, almost 82, and we're not done yet. Another thing we can do with gross margin is increase the income per unit. So we could sell calves, our weaned calves, which fall into our stocker enterprise. We can sell them when they're more overvalued compared to maybe in the past, we've always grown them to 700 pounds. And what we realized is that we could sell them sooner, and actually they may be more overvalued when they're at a slightly lighter weight. And it's just the idea of paying attention to the market and trying to market more effectively. There's lots of ways to do that, but this would just be one example of increasing income per unit. And now when you look back at this gross margin, we actually went from 81, which was a big improvement, to 84.5. So the idea with gross margin is to increase our efficiency. We're keeping, now instead of keeping 77 cents of every dollar our stockers produce, now we're keeping 84 cents. Now, once we have our operation operating efficiently, then we can ask, is it time to actually, is it time to grow? Or we have one other option for actually increasing the total dollars produced. We've got turnover, which doesn't increase our expenses. We're using the same resources, but getting more production. And here's some great examples of turnover. Increasing carrying capacity on the same acres, trading calves multiple times a year, or an additional cutting of hay without additional fertility. This is the option, growth, that a lot of people go to first. And I hope you can see with the gross margin discussion, you can be so much more effective if you start with gross margin and make sure you're operating really efficiently instead of going straight to growth. And you're going to be even more successful if you can do a combination of all three of the tools. But with growth specifically, this is like picking up a new lease. This is you'll increase your overheads, your rent, potentially increase labor. There could be many different expenses that increase here. You're basically applying the same operating plan that you had before, but you're applying it now to the new land and getting more production. So it's really just doing more of the same. So it's a good idea to make sure that your operating plan is as efficient as possible before you start to grow.
Another way to increase gross product is what we're looking at is going from primary custom to starting to own more cattle. So that'll increase
Can
our
you say
gross
that again?
product. Yeah, another way to increase gross product, which is what we're doing, is going from primarily custom to owned cattle is what we're trying to do.
Yeah. Yeah, that's interesting. And I did not include at all in any of these slides, like adding an enterprise or layering an enterprise. So that's a really good point. And I think it would actually kind of fit into the growth concept where you can grow. And in this case, we are showing growth. So let's call it a combination of things: increased forage production and utilization, increased trading. And in this example, let's just say that they did have an additional lease, or in your case, Treg, I guess you wouldn't have an additional lease. It would just be potentially, well, you may not have any different expenses with if you're just going from custom to owned, right? Would they be mostly the same?
Yeah, it should be mostly the same. I'll take on more like mineral costs and trucking, but those are all direct, really. So
Yeah. Yeah. So limited difference there. The main thing is when you're making changes, particularly increasing gross product, just be mindful that increasing that gross product, it may or may not change your direct costs, like you said, Treg, but it most likely will change overheads, particularly growing. So in this case, I did put some additional pasture rent expense here, and so you can see that there. But we're increasing our units produced from 68 on the cows to 85 and 65 on the stockers to 130. And so we've made our operation more efficient and we're running more units, which is a powerful combination for increasing profit. Okay, so if you remember when we first increased our overheads by 10,000, it jumped from 40 to 50%. But now you can see that once we've made some of these additional changes in efficiency and with both turnover and growth, our overheads are actually slightly decreased on a percentage basis of the income that we are producing. So that's what we just went through there. All right, so let's go over our profit planning checklist. We've identified our goals. Specifically, we got to the salary adjustment. What do we want for our personal living? Our lifestyle goals. We've identified our target net operating income. We've made sure our overheads are reasonable. That keeps us lighter. We've addressed our gross margin and made it as efficient as possible for each enterprise. And we didn't even begin to address the hay enterprise, right? Like that's a whole nother thing. But we did make the cow-calf and the stockers as efficient as possible, keeping more of every dollar. That's working smarter. And then we've got gross product. We want to make sure that that's as powerful as possible, producing as many dollars as possible. And that's often done through turning faster or getting bigger. So the big question, once we've done all this math, did we actually succeed? We did cover our family living. We had an extra $10,000 here in overheads to cover our family living increase. Here, we created enough profit to cover the additional $18,000 of debt payment that was included here in this 30,000. And we did this by increasing overheads by $14,000, improving our gross margin from 70% to 76%. That means we're keeping an extra 6 cents of every dollar that we produce. And then we're increasing gross product right here by 42,800 by running more cattle on the same acres. And in this example, we actually added a few acres also. So now we have a plan. I will say we succeeded in creating a plan, but we haven't succeeded yet in actually implementing the plan and executing the plan. So yes, we can give ourselves a high five, but we're not done yet. This process is used for high-level strategic analysis. It breaks down profit by enterprise, which is really helpful when you're trying to make these strategic changes in your business. But there are a few limitations. Specifically, this does not consider the timing of cash inflow and outflow. So this is where you can have a fantastic plan for creating profit, but if you run out of cash, you don't even get to operate. You don't get to follow that plan through. So you have to be careful about how you manage the cash. And then the other thing it does not consider is the financing. Are you able to finance it with cash all the way through, or do you need some debt available to help you bridge the gaps in your cash? And both of these limitations are considered when we start to look at cash flow. And so we just want to emphasize the importance of cash flow here. You can have a fantastic plan for profit, but until you have a plan for cash flow, you've only got one part of the plan. Both profit planning and cash flow planning are critical to success. Okay, this is the last thing I have here, the road ahead. You're the driver. Make sure you define your destination with clear, measurable goals and break them down into manageable annual chunks that you can work toward every year. Tune up your engine with profit planning. That's what we talked about today. Keep fuel in the tank with cash flow planning. That's what we're going to talk about in the future. And enjoy the ride while you build a meaningful life. Make sure that where you're going is where you really want to go. That's what I've got, John. Are there any
Awesome.
questions or comments in the chat?
No, this is very good. Very few comments in the chat today, so I'm going to take that as a good sign. As Danny mentioned, this will be available. It'll take a couple days to get it processed and up on the YouTube channel, but it'll be there. You can access our YouTube channel directly from YouTube, or you can get to all of these videos also through our website at ranchridellc.com. I strongly recommend subscribing to our YouTube channel because then you get notifications when we put new stuff up. We are going to do another webinar just like this one again on the third Thursday of what'll be September. Next month's topic, we're actually going to be talking with some land trust people. We're going to be talking a little about layering enterprises. So it's going to be a slightly different format than normal. And then we will be back with Michaela in October to continue this sort of basics of financial series and running through different pieces of your specific financials. Any other questions, comments, thoughts? I'm really glad you are all here. Thank you very much for coming. Really enjoyed having you.
Thank you.
You must have answered all the questions, Michaela. You're either a very intimidating presenter or you got it all covered. You're very thorough.
Oh, you know me, John. I always have another question.
Excellent. Let's hear it.
No, so I think you're probably going to cover this next month because you talked, Michaela, I think you said, or at the next presentation about cash flow. but I still get confused about profit and cash flow. And is so the profit, I always think of, oh, well, if we have profit, then we have cash, but that's absolutely not true,
Right.
right? So cash flow is like turning, you actually have to have a realized sale. Or
Correct.
Yes.
how do we make that distinction between profit and cash flow? I know this, I think it's really an elementary one, but I'm confusing myself.
It happens a lot. It's a great question. So the thing that really helped me understand it was realizing the difference between like the production of the value and actually turning that value into cash. Just like what you said, you could be creating value and be profitable raising calves, but until you actually sell them and create that cash flow, you're going to be strapped for cash or operating on credit. I think you said it really well, Danny.
Okay, I think that makes sense. So when we're tracking profit with our accounting software and the
Mhm.
way that y'all do it, we're basically tracking our potential, and then the cash becomes the reality. Like the actual sale becomes the reality.
Yes.
Okay. Okay, I think that makes sense.
Yes, I think that was
One thing to think about there, you know, the heifer is born. She is on the place that increases the value of the herd, right? When you receive a check for her, you put money in the bank. And
Perfect. Okay.
usually economic value production precedes cash flow, right?
Okay.
We
Yeah,
have to produce the value and then we have to convert it to cash. That's not always the case, but that is the most common case.
perfect. Thank you.
Yeah, you bet. Good question. Really good. Tell James I said hi, please.
I will. I told him to get on the call, but he's still like on a job site and he was
I'm
frazzled.
sure
I'm
he's
gonna
busy.
I'm gonna make
Yeah,
him watch it.
good. Awesome. What other questions do we have? Michaela, I think one of the massively important distinctions you make here that we have tried to make for years is that owner pay is not profit. Assuming the owner works in the business in some capacity or another at kind of a base case. And too often we see that owners are not paid in the business. They are paid out of quote what they think of as profit. Owner pay is an overhead. And
Mhm.
we've fought this fight on debt service too, right? Debt payments are not overhead. They're debt payments. That's a different thing. Owner pay is not part of profit. It is an overhead. And the same when we hear about, what do you want to do with profit? Well, we want to go on vacation. Well, that's not profit, that's owner pay. Now, you have to have a profitable business in order to be able to pay the owner. That's an important thing. But owner pay is an overhead. And you said the word salary here, and I just want to make sure nobody's unclear that this, depending on the entity structure, it's kind of no matter how you take money out. So we often use owner pay or salary as kind of a generalized term that may include distributions, that may include owner draw. There are a number of those things, but those things you are doing to support your family from the business, we always classify as an overhead.
Mhm.
So
It takes
great.
discipline to think of it that way, but I think it does help,
Correct.
particularly when you're trying to compare your business to others and measure your success.
That's right.
It's really important to do it that way.
Yep. Very, very good. Wonderful. All right. I got to go pick up kids from school. Oh, Betsy, go ahead.
Well, hopefully this isn't a long question, but when you're figuring your debt coverage ratio,
Mhm.
the annual loan payments, so if you have a land payment and then like machine or cattle or whatever term payments you have, then how does your operating fit into that, or does it?
Very good question. So when we're talking about term debt payments, we're only talking about like long-term debt payments. So your current operating note would would not fit into that. And the reason why is we hope that you have current assets that are offsetting any current debts you have. So we
Okay.
hope you know, when you take out that line of credit and have operating expenses, those should be paid back with the production from that year.
Okay,
Alternatively, when you're paying off land or equipment, you're gonna be making that payment with the profit from multiple years. Does that make sense?
yep, that does make sense. So, okay,
Good question, though.
okay,
Great
thank you.
question. And often misunderstood. So when we say long-term debt, term debt, we're speaking separately from line of credit. And
Okay,
Michaela, that even includes like revolving lines, right? So even if you don't necessarily have to renew yours on a 12-month cycle, we still include that revolver as a short-term note.
okay,
Yes.
And then good.
In an ideal world, a revolving line of credit is just for convenience, right? So like you
Correct.
pay your operating expenses and you pay it down with operating income. And it's really just convenience that it's revolving.
okay, awesome, thank you.
Because without a set of caps or whatever that you're putting out there, you wouldn't have that line of credit, right? I mean, that's the whole idea behind it.
Exactly.
Yes. Okay.
The line of credit provides liquidity different, right, from a term note, which gives you buying power.
Mhm.
Perfect.
And that's part of when Michaela had that very first piece where she showed that we kind of crossed income off on the bottom there. That line of credit interest becomes kind of important there at the bottom because when we're talking about term debt coverage, we are including the interest and principal. When we talk about the line of credit, we're really only looking at the interest portion of that.
Yeah, good point.
Because that's what it costs. That's what it actually costs you.
Yeah, it's literally just the cost of the money, right? You borrow money, the bank makes money on you borrowing money. That's the cost. Very good. Thank you, George. Glad you were able to be here. Thank you, Betsy. I appreciate the questions. Really good stuff.
Thank you.
Okay, I'm going to run and pick up kids from school. You guys have a wonderful afternoon, and we will see you next month, third Thursday of September, which is going to be here before you know it. Hard to believe August is already done. If you haven't been, you might take a quick look at the Bighorn Classic sale that's going on Superior today. I've been joking that we're going to break $3,000 calves here shortly, and we did it in spades this week. So $3,000 per head on calves on the Superior Livestock Auction there at Sheridan. So
I don't know if it's on this one or not, but the sale they had a couple of weeks ago, the auctioneer that